Okay, thank you very much. I am going to make basically 4 points. One is on what I think is the issue. The other is about the program of Syriza, or main ideas that they have. Then the other is how far is that from what's happening in the EU. And then perhaps go back to the main policy dilemma facing both Syriza and EU on the other side. So let me first go through some of the main data, because this is the main issue. How did we get here? This is the issue also raised today by Paul Krugman, much more eloquently than I can do that, but you can see here that this is GDP nominal in euro, and the decline from 2008 to 2013 is really very, very large, by probably close to 1/3. There is also inflation that you can see has turned into deflation at the end of this period. We have inflation figures. We don't have GDP figures, well, reliable ones for the last year, but it's not very impressive. So we have that. Then we have, which is also mentioned very often, this is average annual wage in euro thousands. You can see that there has been a significant decline in wages. Again, this is in thousands of euro, and you can see that the decline has been probably about 20–25%. This is unemployment and employment. You have again, this is all full numbers, not growth rates. You have a dramatic decline in employment, and probably about 1 million new, or 1 million increase in unemployment. Here is what has supported this decline of GDP. So you have household and government consumption. You can see that this has gone down. Again, this is all in euro. The total has also gone down. But what is interesting is that there is a dramatic decline. This is this, I think, yellow one at the end, down, the dramatic decline in investment. So you see government and total, and then households. So consumption and investment have gone down. Now, what is interesting is that with all these changes, there hasn't been actually an increase in exports. These are also exports in euro from 2008 to 2013, and goods and services export in 2013 is still below goods and services exports in 2008. So it has recovered a little bit from the slump of 2009, but you don't see, as you see in some other countries that were subjected with the same program, let's say in the Baltics or somewhere else, where this has actually had an effect on growth of exports. This has not actually happened in Greece. I think this is extremely important, because nothing in the program that Syriza offers addresses this question of competitiveness of the Greek economy. Now, this is the public debt development. You can see that it went to 350 billion euro. It has gone down after this restructuring in 2012, and then has gone up to about 319, which is about 175% of GDP. So, as you can see, the public debt has, I'll make that point later, but the public debt has certainly increased very much as a share of GDP, because GDP has gone down very dramatically. Now, another thing that sometimes is not discussed in this context, which may actually be very important once they start negotiating about this money business, is non-performing loans in the Greek banking sector. It's about close to 35 now. So, and as you know, last year, the year before, there was in 2013, there was already a type of a recapitalization of the banking sector. So you see that at the end there, this has slowed down, the growth of the NPLs have slowed down, but essentially this doesn't look as a very solvent banking sector. Now, if you have debt restructuring, that will have to go also through the banks, and we have to see how this will work. So let me go back to, this is the main issue. This whole adjustment program has actually been bad for Greece, whichever way you look at it. So obviously, the legitimacy of the parties that have supported it has disappeared, and we now have a new party, which is how democracy is supposed to work. Now, when you look at what is really the main issue, if you are discussing the public debt as the center of this whole thing, you can see that in 2013, debt to GDP ratio was 175%, as I already said. It was 113 in 2008. This current debt would have been 138% if GDP were like in 2008. So you see that the increase in debt is really driven very much by the GDP decline. Now, if the growth would have been 3% nominally in the last few years since the crisis, and this is the growth rate that is actually projected to be something that in the medium term could be expected in Greece, we would have had now the same debt to GDP ratio as we had in 2008. So it's all basically about the GDP growth. Now, how terrible is this debt? Well, the implicit interest rate, according to the DG ECFIN data, is currently 2.5%. So yes, this is very, very low, and this is because of this all restructuring that has actually brought down the interest rate very, very low. Obviously, Greece must be interested in maintaining that type of arrangement. But now most of the debt is owned to sovereign creditors, meaning EU funds and EU governments. So it must be in the interest of Greece to keep this interest rate, because it's obvious that if it breaks down in negotiations with the EU, then it has to go to the commercial market, and then you have a different interest rate out there. What it would be, I have no idea. Now, if we assume a growth rate of 3% from, let's say, 2015 onwards, and primary surplus of about -1, then fiscal deficit that would need to be at that time would be about 5%. That would be, this arrangement would then leave the debt to GDP ratio sustainable at the current level. So that would be one proposal. This is what you could do, and we have this kind of a debt to GDP ratio sustainable. Obviously, if growth surprises on the upside, then of course you have even a decline in the ratio. Currently, however, as you can see down, the situation is different, because primary surpluses are being projected to be positive. So from this last year, it should have been 2.6, then 3.3. This is from the program, current program. That will have to be negotiated if the negotiations happen. So you can see here, and that's my main point, there is about a difference of about 2 percentage points of GDP that could be actually negotiated. This current program of EU with Greece assumes secular decline of debt to GDP ratio until 2030 to below 60%. So the issue is, do you have 2 percentage points more in primary surplus to pay back and draw down the debt, or you have 2 percentage points money available to Greece with a sustainable debt of current level? So that's sort of the issue, main issue that will have to be debated now. So I summarize it here. I just want to point out that the Thessaloniki program that Kurt already mentioned or discussed calls for about 11.3 or 11.4 billion in extra spending. This is obviously not for 1 year, so we are really talking about 2 percentages of GDP additional fiscal deficit or fiscal or spending per year, basically, because this 11.3 is about 6% of GDP. So if it is for 3 years, that would be 2% per year. This is about what you can discuss also in the other. Now, I didn't put it down, but I can mention here, Syriza wants a write-off of 1/3 of the debt, which takes the debt down to about 116% of GDP and earns about 2% GDP additional spending under the same conditions of growth and interest rates. The interest rates need to be preserved, otherwise this is not a good calculation. So we are really talking about 2 percentage points additional spending by Syriza, and how do we, or Greek government, and how do we allow for that? Do we have a debt write-off, which I think is not really going to work, but we'll find out, or do we have prolonged sustainability of the current debt, rolling it over, or we essentially allow some either extension or new cut in the interest rate to allow for this 2%, which I think is not really very, very feasible and probably will not work. So this is the main issue. So as you can see, I say here, this does not look as if cannot be worked out really. So this is my main point. Now let me just make 2 small points. What does Syriza really want to do? Well, it wants to increase consumption, investments, and have a fairer system of taxation and social transfers. I don't think, given this is all within this 2% and the tax reform that has already been mentioned. More progressive taxation and structuring of the social net and so on. This is all about domestic spending. There is really nothing on exports. There is some idea that long-run investment in human capital should work, but really nothing that would allow for export-led growth. So this is, I think, something they will have to think about, because usually in Greece, if you have increased investment and spending, you will have an increased deficit in the current account, and then you have to borrow money, and that can create problems. How far is Syriza from what is being now discussed in the EU? Well, I think essentially, to me, in the Syriza program, there are two things that are already basically EU programs. One is QE, the Thessaloniki program asks strongly for quantitative easing. We know that ECB is not going to do it automatically for Greece, so that needs to be negotiated. The other thing is investment, that is in the Juncker program. Will it work? That's another story, but it's an official program of sorts. Structural reforms, including industrial policies and so on, do not really appear significantly, as I already said, in Syriza's program, so I have no idea what the government will do, but the EU is ahead in that, at least in words, in that respect. So that would be connected with this exporting capacity and so on. And finally, there is a discussion of EU-wide unemployment insurance, which I think is what the left, modern left, at least as I see it, would argue for, and that is actually that there is a EU-wide extension of various types of insurances. You can start with unemployment insurance, but you can then think about pensions, health, and stuff like that. So this is again where at least some people in the EU are ahead of Syriza. So I don't see significant incompatibility. Of course, the rhetoric is one thing, but in Greece, the elections, you have to have strong rhetoric. What will be the program? I have no idea. But the one thing that is good about Syriza is that and the Greek voters, in fact, do not really want to either get out of euro or get out of the common market. The issue fundamentally about leaving euro is whether you can leave euro in the condition in which Greece is now and remain in the common market. If not, then by leaving euro, you need to leave EU. The Syriza actually does not have a mandate for that. Thank you very much.